You ran the numbers, saved your down payment, and then your FHA loan came back higher than you expected. That surprise usually comes down to one misunderstood line item most buyers never hear about upfront. I'm Jermaine, your Arizona realtor, lender, and fellow investor. And today I'm breaking down why FHA loan amounts often come in higher than expected, how upfront mortgage insurance works, and what that really means for your payment. If you've been wondering how FHA loans actually work, especially the mortgage insurance part, you're not alone. Let's break it down. FHA loans are government-backed mortgages that let you buy a home with as little as 3.5% down. And with any FHA loan, whether you put 3.5%, 10%, or even more down, the loan always comes with mortgage insurance. Part of that is an upfront piece called the UFMIP. The upfront mortgage insurance premium is 1.75% of your loan amount. So if your loan is $289,500, your UFMIP would be $5,066.25. You can either pay that at closing, or you can roll it into the loan itself, which is what most buyers choose. Why does this exist? That upfront insurance protects the lender, not you, but it allows the government to back these lower down payment loans, opening the door for more buyers to qualify. Let's look at how that works with real numbers. Say you're buying a $300,000 home. With 3.5% down, you borrow $289,500. Add the 1.75% UFMIP, and your new loan amount becomes $294,566 if you roll it in, not the purchase price minus 3.5% like many people expect. This is one reason FHA is so appealing. You don't need to bring that extra money to closing. And FHA loans often offer lower interest rates than conventional loans, especially for buyers with moderate credit scores. Yes, conventional loans can go as low as 3% down, but the interest rate is usually higher, and the mortgage insurance is risk-based, so buyers who are coming in with the minimum down payment and average credit, which often includes first-time home buyers, can see higher overall costs than with FHA. And here's an important difference. With FHA, the mortgage insurance doesn't just fall off when you hit 20% equity. For most newer FHA loans, if you put at least 10% down, the monthly mortgage insurance can drop off after about 11 years, but with less than 10% down, you're paying it for the life of the loan unless you refinance into something else. When you look at debt-to-income limits, USDA loans are usually the strictest, then conventional, then FHA, with VA loans often being the most flexible. FHA sits on the more flexible end of that spectrum, which means you can sometimes qualify for more home, even with existing obligations. But here's the key takeaway. Rolling in the UFMIP means your loan balance will be higher than you may have expected. It's not just subtracting 3.5% from the purchase price and calling it a day. If you have any other questions about FHA loan costs, then let's talk. I'm always here to help homeowners and future homeowners like you. Got questions? Call or text me at 480-800-HOME. And don't forget to like, comment, and subscribe for more Arizona real estate tips. Have a nice day.